My name is Eri Mitsostergiou. I'm doing European research for Savills. I have a bit of a special connection with Southern Europe. I'm Greek, as Richard said. I've lived in Italy and Greece, of course. I speak most of the languages speaking in the region. So probably it's not a coincidence that I was chosen today. As Richard said, I'm just going to talk briefly about, give a general overview on the economic situation in these markets, focusing on the commercial real estate sector, looking a bit on the risks and opportunities. Maybe you remember a few years ago at the peak of the crisis when satirically some economists called these markets the pigs of Europe. Today we will discuss how these markets have moved on and how they are getting rid of this stigma of being the pigs of Europe. Or maybe it's a good thing to be a pig, who knows. Economy. All the markets have entered a growth now. Obviously, Spain is standing out, and we will see that Spain is really outperforming most of the European markets in terms of economic growth for now, this year, and also the outlook. Growth is a bit slower in Portugal and Italy. Historically, in Italy, it has been at quite a modest economic growth in the past. Greece is still under the pressure of austerity and still is trying to get over the recession. The commercial real estate market is broadly correlated with the rest of Europe. The period where we saw investors avoiding Southern Europe whilst returning to the rest is after the years of the crisis in 2010, 11, 12. After that, a return has been noted in Southern Europe, a gradual return of investors in Southern Europe. Last year, in 2015, the volumes in Southern Europe increased by 27% compared to 18% in the rest of Europe. And this year, our projection is, actually with some new figures that I have, is not even minus 2%, is probably a little bit positive as well. For Southern Europe, whilst the rest of Europe is dropping by 15-20%. Obviously dragged down by less activity in the big markets of the UK and Germany. Spain is the biggest market in Southern Europe. Spain together with Italy. These both countries, in the first half of this year, have above long-term average, 20 to 40% above long-term average investment volumes, which reflects how active they are. However, it's still worth remembering that this region accounts for only about 6 to 7% of the total activity in Europe, while Germany, France, and the UK account for 65%. The share of Southern Europe is still small. In terms of the sectors that investors prefer, in Southern Europe, retail is quite a preferred sector. Of course, prime offices in CBDs are always popular. In Spain, the retail sector accounts for 43% of the activity, which is way beyond the European average of 22%. In Italy, it's around 1/4 of the activity, but this year we saw almost an 80% increase in retail activity in Italy, driven by demand for also shopping centers and high street units. In terms of where the capital comes from, in Southern Europe, 2/3 of the activity of the capital comes from cross-border investors, compared to an average of 47% in the rest of Europe. So, really, cross-border investors are driving the deal-making process. National investors, though, their importance has been rising the last couple of years. We saw it in Italy, and we saw it also in Spain through the local REIT structures who have actually led, in a way, the activity in Spain. However, bear in mind that there is a lot of international capital hidden behind these REITs. If we analyze a bit more the origins of the cross-border investors, Europeans are, again, the most dominant in Southern Europe. Their share increased significantly compared to last year, from 40% to over 50%. The Americans have a steady almost 1/3% of the share of the activity. And this change in this difference in the share of activity is attributable to the fact that Middle Eastern and Asia Pac investors were a bit less active this year. Nevertheless, if you look closer to the deals, you see very interesting, sizable deals in all these markets happening and driven by by investors from Middle East and Asia Pac, particularly in Italy. I would say, as a general comment, if the right product is there, then they're interested. So, why Southern Europe? What happened? And all of a sudden, the pigs started being more interesting. In 2011, bond yields were quite high in all these markets. And in 2012, there was a significant drop, which reflected the reduction of country risk in these markets. And obviously, very quickly, it helped investment confidence to come back. And this also went hand in hand with the first signs of economic recovery, with the first signs of the economies of this region doing better, coming out of their troubled period of the crisis, which was supported with a lot of reforms, bailouts, with tough austerity measures, and they all have started improving their economic position. In the real estate market, there was also a very interesting story at this stage, because prime yields had moved out significantly in this region. They were way beyond, obviously, their peak. And in 2010 and 11, in 2012 actually, the yield gap, the yield spread with the core markets was really big. So the yields in the Southern European markets and the yields in core European markets, they had a very big gap, which implied a very good potential for future yield compression. Investors that entered the market early, as the benchmark, the IPD benchmark shows, were rewarded, particularly in Spain, positive, growing total returns, outperforming core Europe. Italy, once again, more modest figures of growth, however, still positive and rising. Today, the yields in this region have compressed significantly, especially last year. There was a steep movement, inward movement of yields. They are probably more or less at their past peak levels. Prime yields always. Secondary have not moved in yet as much. But Southern Europe remains more attractively priced broadly compared to core Europe and other European markets. I think the most attractive part is that the yield gap with the risk-free rate is very satisfactory, because we have historically low risk-free rates. The risks on the economic growth, one are, some demographic characteristics of these countries, very high youth unemployment and aging population. These are risks for the productivity and, of course, the fast economic recovery. The much discussed burden of the NPL ratios that we see in these markets, and the deleveraging of banks. The deleveraging process of the banks has been slow in some of these markets. However, we are at a point where in all these jurisdictions, governments are taking all the necessary measures to tackle the problem. In Spain, already in 2012 was the SARB Bank set up, so they have introduced the problem much earlier, so it's in a better shape. In Italy now, they have set up the Atlante 2 private equity fund, which is going to focus on buying NPLs. In Greece as well, now after much tighter European Union and European Central Bank checks and controls, they have put together the institutional framework to start selling NPLs. And already demand from international loan management companies is emerging. So according to KPMG as well, they expect much more sales to happen in the short to medium term. And also the recovery of the improvement of fundamentals in the real estate sector is also helping for this process. Finally, politics. I'm not going to go in too much detail into that, but there are political stability and political leadership is important, obviously, to economic recovery and growth. We know the political situation in Spain is difficult. The Italian Prime Minister is facing a tricky referendum in a month. The Greek Prime Minister is constantly, on a daily basis, facing challenges. Interestingly, these guys met last week, or a couple of weeks ago in Athens, pre-Bratislava, in order to raise their voice within Europe, with the support of France, interestingly, asking for less austerity and more growth, whatever it can be offered in terms of measures and relief to stimulate growth. So, are there still opportunities in the region for us, for our industry, for commercial real estate? We believe that there are opportunities. The economic recovery is on its way, so it will, beyond the prime assets, that many of them have already been transacted, we will see more opportunities. In the retail sector, we believe that there are some still undersupplied regions in the whole this geographical area. We believe that there are assets that require more active asset management and refurbishment, redevelopment, and these can bring some interesting returns and rental growth potential. And also high streets. We already saw the rise, as I mentioned earlier, in Italy this year, with investors buying high street assets in tier 2 cities, but tier 1 tourist destinations, if you like, in addition to shopping centers. Also, in the retail area, also we see interesting opportunities for retail parks. Because it's an evolving concept, is changing with the focus of the consumer towards convenience and value. So that could be another area to look at. In offices, the improving fundamentals make the office sector interesting because rental growth is expected to come in the future, in the near term. Already in Madrid, we saw the prime rents increasing by 4% this year. Take-up has increased by 30% compared to last year. And also, it's interesting that the rents are still 30 to 40% below their previous peak. So there is the potential of recovery in this sector. So refurbishments in the CBD of secondary offices, and even as demand expands, even peripheral offices could be an interesting opportunity. Other sectors, the growing importance of e-commerce is also creating new also areas of opportunities in the logistics sectors. The logistics sector, again, is still small in these countries, but this year, again, we saw like a 30%, 34% rise in Spain, 80% rise in Italy in volumes into the logistics sector. And I think this is mainly driven by the requirements on retailers from the e-commerce, the growth of e-commerce. Let's not forget that these markets Southern Europe is a top tourist destination globally. So the tourist sector, and also like the expectation is that tourist numbers are going to grow, also with tourists possibly avoiding Northern Africa region and Turkey. So second homes, hotels, a bit more specialist project, but still worth looking at. And finally, the privatization of public assets. Last week in Greece was finalized the deal of the privatization of the old Athens airport, which is going to bring like 3 million square meters of a massive mixed-use development over the 15, 20 years. This has been a massive, it was a big project. It was a 1 billion sale to a Greek-Chinese consortium. There are more assets, of course, not of this size. This is exceptional, but there are more sizable and prime assets coming onto the market out of this process. In conclusion, So economic recovery is happening. The governments are working hard on that. They are taking all the measures that they need to support it. And also the big question about the deleveraging of the banking sector is addressed. Commercial real estate investment is strong, and we expect that it will remain high, and it will benefit from further yield compression, particularly in the non-prime segment. Opportunities, as we mentioned, offices based on the improvement of fundamentals, retail parks, shopping centers, high street, e-commerce related to the logistics, and finally tourism.